So we'll be looking at audit evidence. So we'll start from where we stopped in our last class. We stopped at analytical procedure. Analytical procedure. If you remember that analytical procedure is one of the method of generating audit evidence. You remember, it is one of the sources or method of generating audit evidence. So, but however, there is a standard that talks or that there is a standard that treats analytical procedure. So we are going to look at the meaning of analytical procedure, the extent of which analytical procedure, the extent of use of analytical procedure. So we are looking at that now. And we are going to look at the example of analytical procedure that an auditor can use. So what do you mean by analytical procedures now? Now, the standard that treats or that make reference to analytical procedure is called International Standard on Audit 520. So it talks about analytical procedure. So it defines what analytical procedure is. This standard also gives the nature of analytical procedure and the extent of use of analytical procedures. This standard actually states this about analytical procedure. So let's look at the analytical procedure now. Let's look at that. What do you mean by analytical procedure? Analytical procedure can be defined. It is defined according to International Standard on Audit 520. It defines it as an evaluation of financial information. The evaluation of financial information through analysis of relationship. Through the analysis of relationship among financial and non-financial data. That means you are analyzing the relationship now. You are evaluating and you are analyzing the relationship between financial data and non-financial data now. That means you are checking the revenue now. Why is the revenue like this last year? Why is it like this year now? That means what you are carrying out is analysis. So mainly analytical procedure is mainly about what? Carrying out what? Analysis of financial and non-financial data. So when you carry it out, you now be able to know or to evaluate the financial information. So let's go to example of analytical procedure. One of the example of analytical procedure is we have ratio. You know, what does ratio do? Ratio is used to analyze the relationship between two variables. Are you getting what I'm saying now? So an auditor can use ratio to carry out analytical procedure now. Ratio is one of the method of analytical procedure. We also have budget. You know, budget, you compare the actual with the budgeted. What about trend? Some people carry out what we call trend analysis. Just imagine now, the auditor now, let's say a company now made 2 million in last 2 years. They made 3 million in the last year. In the current year now, which the auditor wants to carry out the financial statement and want to audit the financial statement, the auditor now discovered that they made a revenue of 200 million. Can you see? It is that amount now is outrageous. So with the trend analysis now, the auditor can look at the trend of the revenue and look at this analysis. This has been increasing just by 50% or by 30% over the years. Why is it that the revenue just increased outrageously? Now, this is one of the ways that the auditor can use to obtain evidence now. Evidence. So we have also industry average when you are carrying out ratio. This is one of the ways in which you can use example of analytical procedure that the auditor can make use of. Now, analytical procedure is actually concerned with investigating, when you are investigating changes away from the usual trend. Now, let's look at it now. I told us that I made an example of, let's say a company made 2 million in last 2 years. In the last year, they made 3 million. That means their revenue is increasing by 50%. Now, in the current year in which the auditor wants to audit now the auditor, the company now make 200 million naira. If the auditor did not carry out analytical procedure, he will not know that the revenue has actually increased drastically, which may be material to the financial statement. So the auditor will now be asking question, why is the revenue increase? Why the outrageous increase in the revenue in the current year? When the previous year it was 3 million, now it is 200 million. What happened? Can you see now? So it is analytical procedure is actually concerned with investigation of changes away from usual trend. You can see the trend at which that revenue is increasing now. It now increase. Now the auditor can now ask question, why is this pattern moving away from the usual trend? So it's concerned with investigating. That means auditor investigating why changes is moving away from the expected trend, and explaining why these changes has happened. That means the organization now will now, the management, it's the management that prepare the financial statement. They will now need to explain why there is unexpected, or why there is unexpected changes in the trend or in that item. Now let's go to the nature. So we have looked at the meaning of audit and the meaning of analytical procedure and the example of analytical procedures now. So now let's look at the extent of use of analytical procedure. The extent, when we say the extent, it means that the factors that determine the extent that you can use analytical procedure. At what extent can you use analytical procedure? Are you getting what I'm saying now? What can make you to use analytical procedure? And at what point do you stop in using analytical procedure? That's what we want to look at now. Because analytical procedure is actually one of the way of generating audit evidence. So the auditor now, we need to consider some factors. That will determine to extent. There are some factors that determine the extent to which you can use analytical procedure now. So one of the factor is the auditor now is required, because the auditor is required to determine the suitability of the particular analytical procedure. That means, are you using ratio? If you are using ratio, is ratio what? Is it suitable for that particular item? Is it suitable for that particular item? If you are using industry average, is it suitable for that particular item in the financial statement? So it means that the auditor now must determine the suitability of the particular analytical procedure. Now also, the auditor is required to also develop the explanation of the recorded amount. Are you getting what I'm saying now? He needs to explain, okay, if we have used ratio and we have been able to obtain maybe the ratio we use, we discover some abnormality now. The auditor should be able to explain the result of that ratio, or of that example of analytical procedure that he has used. What is the result? He must be able to explain, not just calculate it and just leave it. The auditor must be able to explain it, and in explaining it now, it will now help the auditor. The auditor will now evaluate the misstatement, the expected misstatement of that item on the financial statement. So one is for the auditor. When an auditor is carrying out analytical procedure, he must consider this following now: to know the extent in which he can use analytical procedure now, it means he must determine the suitability of the analytical procedure on for the financial item that he wants to carry out analytical procedure to. Two is that he must develop an explanation of the recorded amount, whether ratio or trend, and explain, and also what, evaluate whether he must evaluate whether sorry let me how is this? Okay, he must evaluate whether there is material misstatement, whether that item or whether that ratio he has calculated can identify material misstatement in the financial statement. Now, the auditor is using data, because whenever you are using analytical procedure, what are you using to carry out ratio, industry average to trend? What are you using? You are using data. So it must also evaluate the reliability of the data used to carry out the analytical procedure. Then if you cannot rely on the data, that means you cannot use audit analytical procedure. And if some part of the data are not correct, that means there is extent to which you can use analytical procedure. So the auditor will also consider these factors now to know the extent at which he can use analytical procedures. Now, lastly, the auditor is required to determine the level of differences between the expected amount is acceptable without further investigation. That means if there is material misstatement now, am I communicating now? What is the expected? What are you expecting? Let's just imagine, like I'm carrying out trend analysis now on the revenue. Let's say they made, just like I explained, they made 3 million in the last 2 years. In the last year, they made 3 million. Now this year they are making what's it called? 200 million. Now, I'm not saying that, from the trend now that I'll be looking at, the revenue has been increasing by 50%. Now, let's look at it now. In the current year, I'm expecting that the revenue should increase by 50 to 60%. That is the expectation of the amount that is acceptable. That means if it's now increased above that amount now, that means I have not expected the revenue to increase above that amount now, so that I will know the extent at which that item can cause material misstatement in the financial statement. Am I communicating now? So what is the extent to which the extent to the use of analytical procedure? One is the suitability of that particular analytical procedure. How suitable it is for the item that you want to carry out analytical procedure on. Now, two is that you must develop an explanation of the recorded amount and evaluate whether there is material misstatement in whether there is material misstatement. Three is for you to evaluate the reliability of the data used for that analytical procedure. And four is for you to determine the level of differences from the expected amount. Am I communicating? Any question on that? Any question? Any question? Let's communicate. Any question?
No, sir.
Okay. Now let's go to audit documentation. What's another name for audit documentation? When you say audit documentation, what's another name? That means you say audit working paper. Yes, audit working paper. Now, there is a standard that treats or that make reference to audit documentation, or that talks about audit documentation. It is called International Standard on Audit 230. It is called audit documentation. So this standard actually provided the content, the form of audit documentation the types of file that you can keep, and the it also talks about the confidentiality of a audit working paper and all. So that's what we'll be looking at. We'll be looking at what do we mean by audit working paper or audit documentation. So let's look at this one after the other. Now, what's the essence of audit documentation? Audit documentation actually provide the audit procedure that will be performed. What are the audit evidence that will be obtained, and the conclusion reached. This is what the audit working paper is going to provide, because it is upon this evidence you have gathered that you can draw an opinion or make a conclusion. So audit working paper is very important in any audit, because if you are saying there is material misstatement in the financial statement, you are saying there is material misstatement, they will ask you what is the evidence, and you are now explaining it with math. You are just explaining this because they are doing this. There should be a audit documentation that will back up your evidence that you have obtained. Are you getting what I'm saying? So that if an independent auditor, that means someone that is not part of the audit now, if the person pick up the audit evidence, audit working paper or audit documentation, it will be able to reach the same conclusion that the audit team has reached. Am I communicating? Are we communicating? So let's continue now. Let's go to the forms, content, and extent of audit documentation. Now, I will explain that in forms of audit documentation can be recorded on paper. It can be it can be on electronic, maybe on flash, on CD. Am I communicating? So the forms, it can be on paper, it can be on electronic or other media. Are we together now? So whether it is paper or electronic, as far the forms, it can either be electronic or it can be on paper. You need to see some organization, they don't like using paper. So all the evidence they have been able to gather will actually be on their system. So now let's look at the content. What are the contents that could be found in audit working paper? What is the content of audit working paper? Now, audit working paper can have the content of audit paper actually depend on the nature and the size of the client. The nature or the size of the client, the complexity of the audit processes. Are you getting what I'm saying now? That is what determines the content of audit documentation. For a small organization now, that means the content of the audit documentation may not be that much. Are you getting what I'm saying now? The content of audit documentation, it depends on the nature and the size of the client and the complexity of the audit process. But however, in audit working paper, what you should have, the content of audit working paper should be what are the audit program that has been performed, what are the analysis that you have done, what are the summary of the significant matters. You will find it in audit working paper. What are the letter of confirmation or written representation from the management, because it's also a way of obtaining evidence too. It will be found in audit working paper too. Checklist, what work has been done. You will look at it at audit working paper. Who has performed the work? What area of the work was what area of the audit was performed, and who has performed it. You will see it in audit working paper. Different corresponded to, you will see it in audit working papers or audit documentation. Now, before I go to the extent of audit working paper, let's look at the types of audit file. We have two types of audit file. We have permanent file and current file. Permanent file and what? And current file. What do you mean by permanent file? Permanent file record the information that is likely to be significant to every annual audit of the client. That means every time that you want to carry out an audit for that client, in every year that you want, any year that you want to carry out audit for that client, you will always make reference to that file. That is what we call permanent file. So any year, whether it's 2019 or 2024 or 2016, anytime you are performing an audit, you want to perform an audit for that client now, for your client, for that particular client, you will always make reference to that what? To that file. That is what we call permanent file, because it's going to be significant to every audit of the client. And what are you going to find in permanent file? What are the contents? What are the things that you find in permanent file? What the constitution of the company, the legal constitution of the company is going to be in permanent file. Legal documents, maybe they obtain a loan, is going to be in the permanent file. Now, the summary of the history of that organization, the ownership of that organization, who owns the organization now, is going to be what? Is going to be in the permanent file. Also, what is the accounting system or procedure that the client is using, is going to be in the permanent file. Now, the copy of the previous year financial statement, you are going to what? You are going to what? So every year, as anytime you complete the audit, the audit of that client, you put the copy of the financial statement in the permanent file. So if you are carrying out the audit for 2024 now, okay, someone is it Madam Richard, or someone is raising his or her hand up? So is that you want to ask question, or was it a mistake? I think okay, maybe it's a mistake. So let's continue now. Mr. Richard, are you asking a question? Because I'm seeing your hand. You are raising your hand up. Okay, let's continue. Maybe it's a. Now let's look at current file. So current file is a file that contains information that is relevant to the current audit year. Are you getting what I'm saying? So if you are carrying out audit for 2024 now, you will open a current file for the audit of 2024. Let's note our mic, please. I don't pay you money. I always try, but I don't pay money. So let's continue now. That means the current file now is only what? Is only relevant to the current audit. Am I communicating? It's only relevant to the current audit. So what are the information that you see? What are the information that you see in the current file now? What are the information? You will see the financial statements for the current year. You will also see the summary of audit adjustments. You know, there are some adjustments that you need to make. Some audit adjustments. Now, it's going to be on the current file. Also, the audit planning document. You know, before you start the audit, you could have drafted the audit plan or the overall strategy of the audit now. It's going to be in the file too. Audit letter, maybe the engagement letter, is going to be on inside the file also. So these are the information that you see in the current file now. So let's move now to computer generated audit working papers. You know, in this part of the world now, auditors are now using computer to improve their efficiency of preparing audit working papers now. They are not using manual, they are now using computer to gather audit working papers. That means most of their audit working paper will be electronic now. So also, auditors are also using computer packages to generate audit working papers too, to generate audit working papers. Now, what are the advantage of you using computer generated audit working paper? Is that when you are using computer generated audit working paper, now your audit working paper will be neat. It will be neat. It will be easy to read, and it will be in a standard format when you are using computer generated audit working paper. Also, there is a low risk. There's a low risk of error when you are using computer generated audit working paper. There's low risk of what? Of error, because it's that audit package that will generate, or that will populate the audit working paper. Now, also, it means that in computer generated audit working paper, that means you know that the audit engagement now, the engagement partner, you know, the engagement partner is the team lead of the audit team. Now that means every area that he has assigned to members of the audit team, now he will need to review it. Now, if the audit team is using a computer generated audit working paper, now that means without the physical presence of the engagement partner or key audit partner, now they can review the audit working paper that a member of the audit team has prepared without physical work present. So this is one of the advantage of audits, of computer generated audit working paper. One, the audit working paper is going to be neat, easy to read, and it will be in a standard format. Two is that there will be what? There will be less errors. That the risk of error will be what? Will be reduced when you are using computer generated audit working paper, because it's the computer that will populate such information that is that will be needed for that audit working paper. Also, it makes it easy for what? For supervising or reviewing the work of reviewing the work performed by the member of the team, by the engagement partner, without physical presence. Now, so we have moved into that now. So let's go to ownership. Let's go to ownership, custody, and confidentiality of audit working paper. Now, the audit working paper belongs to the audit working paper belongs to the auditor. Is the property of the auditor. The audit working paper is the property of the auditor. So it means that the ownership of audit working paper belongs to who? It belongs to the auditor. It does not belong to the what? To the client. Now, let's go to the custody now. Now, the auditor may decide to what? After the audit has been performed, he may decide to what? To keep the audit working paper. But international standard quantity management, quality management, international standard for quality management one made that the minimum period of keeping the audit working paper for a client should be what? 5 years. That the minimum is 5 years. So after 5 years, you can decide to what? To either keep it, or you can decide to what? To dispose it of. But that 5 years will count from the date that the audit report has been what? Has been issued. When the audit report has been issued, that means 5 years after. That means you can keep it. The minimum period for keeping an audit working paper by an auditor is minimum of 5 years. So after 5 years, you may what? You may dispose it of. That means according to international standard for quality management one. Now let's go to confidentiality of audit working paper now. That means when an auditor is keeping audit working paper now, it should not, because he has performed the audit. Now, during the period in which he is keeping that audit working paper now it does not belong to the to the client. But however, the auditor is expected to what? To keep that information secret. That means that information should not be exposed to what? To unauthorized person. That means the confidentiality of that audit working paper should be what? Should not be it should respect the fundamental principle. And what is the fundamental principle? You have confidentiality. That an auditor is required to respect the confidentiality of information. Respecting the confidentiality of information means that it should not disclose that information if it is not if it is not permitted or required to disclose that information. So it should respect the ethical guideline that governs confidentiality. So let's go to any question on this before we go to this other aspect now that we have to move into. Any question?
No, sir.
So let's move to related parties. Who can tell me the standard that treats related parties? The standard that talks about related parties.
ISA 550.
No. The financial standard. I mean the financial way, not audit standard. IS 24. See, I'm just telling you now. Don't be surprised. Maybe I'll just try to work on something. Don't be surprised when you are being asked a question that pertains to accounting standard, whether international accounting standard or international financial reporting standard. Don't be surprised. You may be asked in audit, because if an auditor does not understand the accounting standard, are you getting what I'm saying now? He does not understand the accounting standard. How will that auditor know whether the item is materially misstated or not? Look at it now. Let's say inventory, where the auditor wants to test whether the inventory is stated appropriately according to the relevant standard. What standard will he make reference to check whether it has been IS2? It has been recognized, yes, whether the inventory has been accounted for appropriately according to the relevant standard. Now he will make reference to to IS2. So IS2 says that inventory should be measured at lower of cost and net realizable value. So if they don't measure it in lower of cost, that means there is misstatement. Are we communicating now? That means there will likely be misstatement, because audit is the examination of financial statements. Are you getting what I'm saying? By an independent person to show whether the financial statement true or fair view. And when you say whether a financial statement has shown true and fair view, that means whether the financial statement has been prepared in accordance with with relevant rules and regulation and relevant financial reporting standard. So please, I think this aspect talks about standard, because when we get to that place, I won't be treating anything standard, because I've seen when they have asked IFRS 15 in audit before. IFRS 15, they said the organization has recognized revenue in accordance with IFRS 15, and they said they mentioned how they recognize revenue now. They now say, as an auditor now, what is the five-step framework of recognizing revenue? And as the organization recognize revenue in accordance with IFRS 15 based on the case study now. So if you don't know that standard now, you will not be able to answer that question. So it is IS 24 that talks about related party transaction now. So let's look at now, because this related party now, international standard on audit 550. What is talking about is that he explain what related party is and how the impact of the related party, that means how an auditor should audit a related party transaction. It's not actually specifying how related party should be accounted for in the financial statement, because it is the management that will prepare the financial statement and make disclosure. IS 24 is disclosure standard. It does not require you to calculate anything. It's just disclosure standard. That means as the management provide appropriate or relevant standard about the related party transaction that they have, and what impact will they have, Are you getting what I'm saying? That is what the auditor is looking at, and that's what this standard is looking at now. That means the procedures to what? To audit related party transaction. This is what the requirements, and that's what we are looking at now. So let's look at it. What do we mean by the meaning of related party? What is the meaning of related party? Related parties are individuals or organizations that might have or might be expected to have undue influence on a company being audited. That means an individual that we are expected that it is that individual or organization that may have undue pressure, that may have undue influence on a company, or that may what that is expected to have undue influence on a company. That's what we call related party. So if a party cannot influence, are you guys cannot influence, whether individual or organization uh, cannot influence a company. Are you getting what I'm saying now? It cannot be called related party now. Now, that's what we call related. Example of related parties. What do we call example of related parties? We have directors and key members of the organization is family members of the owners of the business are also what? They are related parties also. When you have companies in the same group, let me subsidiary. Are you getting what I'm saying? It can also call a relationship between parent and subsidiary or associate. It can also cause related party. It's an example of related parties. So let's look at the impact. The impact of So let's look at the impact on the audit of related party transaction and relationship and transaction, because the auditor must be able to what? To know the impact. The impact. So now, in knowing the impact, we have to know that it is not all related party transactions that are material that can result to material misstatement in the financial statement. Some may not have material misstatement in the financial statement. Some may have an high risk of material misstatement. Some may not have may not have risk of material misstatement in the financial statement. Now, what can now causes related party or circumstances that can cause related party transaction to have material misstatement, to have high risk of material misstatement? It may be because of complex structure that is involved in the relationship. It may causes high risk of material misstatement. And if the accounting system that the organization has put in place cannot detect or cannot identify related party transaction, that means it can cause high risk of material misstatement. Now, also, if the related party transaction now conducted is not in normal commercial terms, that means it does not have commercial substance, that means it can cause high risk of material misstatement. That means if you are selling a particular item now to one of the, maybe a company now is now selling one of the assets of the company to one of the directors now. Now, if that asset that is selling to one of the directors have commercial substance, please, will it have an high risk of material misstatement in the financial statement? No. But whenever it is not at normal commercial substance, what happens? There's high risk of what? Of material misstatement. Even though the transaction is between related parties, it is not all transaction between related parties that have an high risk of material misstatement. Are you getting what I'm saying now? So it is what I've listed down now. That means if the related party now, that means if that related party transaction now occur through what? Through complex structure or relationship, you cannot explain it. It's very complex. The relationship is very what? It's very complex. That means that transaction is very complex. It means that it can cause high risk of material misstatement. And if the accounting system of the organization cannot detect related party transaction, it can also what cause um, high risk of misstatements. Also, if the related transaction is lack commercial substance, that means it is not at arm's length, it will cause an high risk of material misstatements. Now that means the auditor, because of this now, the auditor is required to what? An auditor, this standard, international standard on audit 550, require an auditor because of this now, because of this high risk of material misstatement that can be caused by what? By related party now. The auditor is required to have an understanding of the related party transaction and relationship. Because if the auditor does not have an understanding of the related party transaction or relationship now, it will not be able to perform an audit or to detect material misstatement of this related party transaction. What are the material misstatement that can cause that this related party transaction can cause in the financial statement? So the auditor will need, it is required. That means international standard on audit 550 require the auditor to obtain an understanding. He should understand the related party transaction and related party relationship now. Now, the auditor should also what? The auditor is required to actually to gather sufficient evidence that will show that the related party transaction and relationship has been properly disclosed. Because related party transaction, the standard that talks about related party transaction in financial reporting is what? Is IS 24. And IS 24 is all about what? Disclosure. And that's why we refer to it as disclosure standard. It means that what the auditor wants to know or wants to be sure of is that related party transaction, is it properly disclosed? When you mean that it's properly disclosed in the financial statement, that means it has been identified, it has been accounted for, and it has been disclosed in the financial statement. Now, let's move to the risk requirement of international standard on requirement of international standard on audit 550, and which is related parties. So we want to know the requirements. So one of the requirements is that the auditor should carry out a risk assessment procedures. I told us that it is not all related party transaction that has an high risk of material misstatement in the financial statement. Some does not have, some have. And I've told you that the reason why some will have, because if I'm a director, I purchase, like let's say I'm buying a particular item from maybe one of the land of the company. Now I'm buying it from the company, and I'm one of the directors of the company. If that transaction is at arm's length, it has commercial substance, that means there is related party transaction, but it was sold to me at a price that they will sell it to a third party. That means even though there is related party transaction, there is lower risk of material misstatement because it is sold at normal market price. Am I communicating now? So let's look at the risk assessment procedure that the auditor will need to consider, we need to perform. Now, the auditor is required to perform the following procedure. I will list the procedure now. The following procedure in order to understand the entity related party transaction, relationship and transaction. That means the auditor now, we understand that there is risk. There can be high risk of material misstatement that related party transaction can cause. But the auditor is required to what? To obtain this follow or to follow this following procedure now, in order for him to what? In order for the auditors to be able to have a better understanding of material of a related party transaction or relationship, because it is until the auditor have the understanding and of this of the related party transaction before he can identify which risk that is involved, whether there is high risk of that related party transaction or relationship can cause an high risk of material misstatement or not. Now the auditor is required now. That means the process, the risk assessment process that the auditor will follow. One, he will consider the risk of material misstatement. What are the risks of material misstatement due to what? Due to error or due to fraud. He will need to consider it. He will need to consider that is related to what? To that related party transaction. Because an organization may say there is related party transaction, and that related party transaction may be what? May be caused by what? It may be affected. That transaction may be affected by error or by fraud. Look at it now. An organization now, they were supposed to sell an item worth 1 million. Now they are now selling to me. Don't forget that I'm the one that will authorize the sales of this of that item now. Maybe of let's say one of the vehicle now. It is valued at 1 million and the company wants to sell it at 1 million. Now, and I say I want to buy the vehicle. And I'm the one of the director, and I say I want to buy the vehicle. We now, the price now, this is the how much you want to sell it. We now say we will sell it. That the amount, that this 1 million now of this asset, that it is not, the value of the asset is not 1 million. That we have revalued it, that is not 1 million. That the value of the asset should be around 200,000. The reason why we are changing it now is because one of the directors want to buy the asset. When I say the value is what? Is 200. Can you see now? There is related party transaction now. That means if the person buy the material, by what? Buy the item now. Let's say the vehicle now at 200,000 naira. What has happened now? There is a material misstatement. Now, the material misstatement is that the item that we are supposed to sell at 1 million, we are now selling to 2 million because we are selling it to the entity is selling it to one of the director. Now, the director that wants to buy it now has influenced the price at which that asset should be sold now. Are you getting what I'm saying now? He has influenced it to be 200,000. And that's why the auditor now, when the auditor is looking at the risk assessment procedure, when he's carrying out risk assessment procedure for related party transaction, he will need to consider the risk of material misstatement due to what? Due to fraud and error. Due to fraud and error from that related party transaction and relationship. Am I clear? Now,
Yes, sir.
2, don't forget we are looking at the risk assessment procedure. The following procedure now, the number 2 procedure that the auditor will also look at is to make inquiry from the management. Now, making inquiry from the management means that to enable him to identify who are the related parties. What are the nature of relationship? What is the nature of relationship between the company and the related parties? What are the nature of transaction between the companies and the related parties? That means the transaction that the company has entered into with the related parties. That is what the auditor is making inquiry from the management. So, after considering the risk of material misstatement due to error and fraud as a result of the material misstatement, it will make an inquiry from the management concerning the identification of material misstatement, the nature of the identification of related parties, the nature of the relationship between the related parties and the transaction that the related parties has entered to with the companies now. So lastly, the auditor now, we need to obtain the understanding. Don't forget, we are looking at the risk assessment procedure. We need to obtain an understanding of the internal control in operation. Are you getting what I'm saying? We need to consider the internal control in operation. What are the internal control systems that the management has put in place to identify or account for or disclose material mistakes? I say material to account for related party transaction. If the internal control is weak for them to organize it now, so the auditor will know that there is what? There is high risk of materials misstatement that will be caused by what? By related party transaction. Am I communicating now? So we have looked at the risk assessment procedure. So let's look at identify related parties and related party transaction. Identify what? Related parties and related party transactions now. How can an auditor identify it now? Because the management will want to what? Because they are the one that will be that the one that will prepare the financial statement. So how will the auditor obtain or be able to what? To identify all these related party transaction, or who are the related parties? Because he's not involved in the day-to-day operation of the business now. Because you can be asked in the exam that you should identify the related parties and related party transaction. If you are given a scenario, you may be asked. So how will you be able to do that now? Now, this is how you can identify related parties and related party transaction now. Now, the auditor will meet. Don't forget, I told you that the when you are looking at the risk assessment procedure, the number 2 procedure is inquiring from the what? From the management. Making inquiry from the management. That means in one way in which the auditor can identify related parties or related party transaction is for him to obtain inquiry, or to make inquiry from the what's it called? From the from the directors or from the management now. Now, one of the way is that the auditor can carry out a what we call test of completeness. Test of completeness. And test of completeness is enabling that will enable the auditor to identify all the related parties and all the related party transactions. And how will you carry out this completeness test of completeness now? The auditors will need to what? It will need to review the previous hello? Let's mute our mic, please. So now let's look at this now. These are the ways in which the auditor can identify related parties and related party transactions. The auditor can review the audit working paper of the previous year now. Because in the previous accounting year or the previous audit working paper, that means the auditor could have identified some related parties from the previous audit that he has carried out, or from the previous audit that the subsequent or other client has actually carried out now. That means the auditor will look at the previous audit working paper, and in that previous audit paper, it will have identified some related parties or some related party transaction. That means it can obtain it from there. The auditor will also what? Review the company procedure for identifying what? Related parties. Because the organization will have a procedure, and that's why they have internal control in place. Are you getting what I'm saying now? What are the procedures? The auditor will review the company procedures for identifying related parties. Now, the auditor now, it will also, the way in which he can identify related parties is that he can inquire the relationship between directors and other entity. What are the relationship between directors and other entity? Like the suppliers, the family members of the directors. He can actually make inquiry of the relationship that the directors have with other entity, with other companies, he can also obtain that. Now, once he's able to obtain that, when the auditor is able to, and he discover that it's a relationship between the auditors and other entity, he will be able to identify that there is related party transaction or related parties. Now, the auditors will also need to review the shareholders what record. You will check that look at the shareholders record, look at their names. Are you getting? Look at the names of major shareholders, because if you know the name of different shareholders now, that means if there is a transaction between that shareholders and the company, you will be able to what to identify that there is related party transaction. Now, one of the other ways that the auditor can identify related parties and related party transaction is that he can review the minutes of meeting or minutes of meeting of shareholders. That means the minutes of shareholders meeting. Once you review it, there may be some aspects or some area where the minute of meeting will expose that they sold a particular item to the one of the shareholders, they sold some item to the one of the shareholders, or one of the shareholder bought particular item from the organization. Now that means he will be able to expose that now, so he can actually use the the minutes of shareholders meeting to identify that there is related party or related party transaction. Now let's look at response to risks of material misstatement. Response to risks of material misstatement. If the auditor respond to risks of material misstatement, if the auditor discover that there is risk of material misstatement as a result of related party transaction or related party relationship, now the auditor will not just fold hand, he will need to respond to the risk of material misstatement. Now that means, how will the auditor respond now? Now, if the auditor has actually discovered that there is an unidentified or undisclosed related party transaction or related party relationship, the auditor is required is required to actually to determine whether the circumstances confirm the existence of the relationship or transaction. Let me just explain that. Let me quickly explain that now. That if an auditor discover that there is unidentified or undisclosed related party transaction, he must check whether that undisclosed um undisclosed related party transaction or unidentified, that means the company is not able to identify the related party transaction, it will need to confirm whether that related party transaction really exists. Are you getting what I'm saying now? It needs to confirm whether that related party transaction or relationship truly exists. Am I communicating? It needs to determine whether it truly it exists, because it may not the related party, the unidentified audit unidentified related party transaction or related party relationship, he may have discovered that they didn't disclose this part now, and what he has is thinking that it is undisclosed or unidentified may not actually exist. So it's one, when an auditor wants to respond to risks of material misstatement, that means the auditor will need to follow this in responding to risk of material misstatement of related party transaction. He will need to follow this procedure. Now, he will need to determine whether he will need to confirm the existence of the relationship or transaction. Now, he will need to communicate the relevant information to the audit team. That means he will communicate it to the audit team, okay, so that the audit team will discuss, or so that the audit team will be able to look at the unrelated party transaction. He will also need to what? To request an explanation from the management. After this, he will request some explanation. That means he will request a written representation from the management now. Am I communicating? He will request management to identify all the transactions from the newly identified. That means, and he will also request that why the organization were not able to disclose or to identify that related party transaction. He will need to look at that. He will also need to carry out substantive tests on that related party transaction that has been identified that the management did not disclose. He will need to carry out uh, substantive testing or procedure on that unidentified or undisclosed related party transaction. Are we together?
Yes, sir.
Okay. Now let's move now to uh, written representation. Who can explain what do you mean by written representation? Because we have been mentioning written representation for quite some time now. What do you mean by written representation? Who can explain what we mean by written representation? What is the meaning of written representation? Where? Yeah,
Hello, sir.
yeah, I'm with you, man.
Written representation can get to be letter that is requested by the auditor from the client to substantiate some claim.
Mhm. Or to provide some explanation on some issues.
Yes, to provide more explanation on some issues that the auditor are not clear about, or it can also be like a written letter from the client giving auditor more confidence on an issue that an auditor has.
Yes, more clarification. Providing more clarification on some issues that the auditor is not uh well uh well clear or when the auditor find it difficult to understand what that aspect or area of the audit is saying. Well, you are right, man.
As additional information.
Yes, it can be serve as additional information because I was mentioning audit documentation or audit working papers. One of the content is also written representation or letter of representation. It's also part of the audit working paper or the audit documentation. So you are all right. So let's look at how, because written representation, the audit standard that talks about written representation is called International Standard on Audit 580. 580 is called written representation. So let's look at how did the standard define written representation now. How did it define written representation? It defined written representation as a statement made by management provided to what? Provided to confirm certain matters or to support other audit evidence. That's how International Standard on Audit 580 define what representation is. Is a written statement by the management. So the management is the one providing the written representation. Is provided by the management to actually provide provide to it is provided by the management to actually confirm some matters and also to serve as support to the audit evidence. Now that's what we mean by written representation. Written representation. So we can say written representation is actually is written representation is being prepared by management to an auditor. Am I communicating to an auditor now? Okay. Mr. Gideon, you are raising your hand up. Hello?
Okay, well, sir, I just wanted to ask, is written presentation general like on the audit? or can we have different written representations issued by the management?
Yes, now there can be different receiving representation. If an auditor is not clear about some certain issue, he escalates it to the management. The management will now write, because the auditor will not want to get verbal explanation. He wants the explanation to be in written format, so that that written format can be an evidence, can be an audit evidence that, okay, oh, maybe the management has actually accepted that there was a material misstatement, or they didn't follow the accounting standard when they were preparing some item in the financial statement, and they will give reasons why they didn't follow the that accounting standard. Now, am I communicating now? Now management, look at it now. Written representation, international standard on audit 580 actually states that the area of that written representation may come in place is that written representation may be obtained from the management. It may actually be obtained from the management that it has fulfilled its responsibility in respect of preparation of financial statement of audited. That means management, the auditor may require the management to actually write a written representation that they have prepared the financial statement, and the preparation of the financial statement is their what? Is their responsibility. Am I communicating? Now, also an auditor can also obtain written representation to support an area that needs what? Maybe additional audit evidence. So maybe an area that is not clear to the auditor may request that the management provide an written representation on that aspect now, so that it can serve as what's it called, as an additional or support audit documents. Now, am I communicating? Now let's go to the content and the forms and content of letter of representation. What are the contents? What are the contents and the forms and content of written representation? So let's look at that. I've explained that written representation can be about management responsibility. That means management claiming or management writing to the auditor that they have fulfilled their responsibility of preparing the financial statement for that year. That the financial statement that they have submitted or they have provided to the auditor, they are the ones that prepare the financial statement. And maybe the copy of the financial statement can be attached to that written representation too. It can also serve as a support to audit evidence. Am I communicating? It can also serve as support to audit evidence too. Now let's go to the forms and content of letter of representation. Now, what are the forms or content of letter of representation? Now, the letter of representation is actually drafted by who? By the auditor. It is drafted by the auditor. The auditor would look at the areas. It will be the one that will say, okay, these are the representation. These are the areas, or these are the areas that I require written representation from. Look at it now. An auditor require an explanation on a particular item in the financial statement now. That means the auditor will inform them or will write to the management stating where he needs clarification, stating the area in which he needs what? Clarification. That means in that aspect, the auditor has actually provided how the written representation that will be prepared by the management should look like. Am I communicating? Should look like. Now, it is usually drafted by the auditor and addressed to who? It is addressed to who? Madam Longe Aminat. You are raising your hand up. Do you want to ask a question?
Is written representation different from letter of representation?
It's the same thing. When you say letter of representation and written representation, is the same.
Okay, but I thought it's written by management. So why are you saying here that it's now usually drafted by the auditor?
Now let me give an example now, man. Now I want to don't mute your mic. Now I'm an auditor now. You are part of the management and you are the finance director now. Now, let's say the um PPE. I'm not clear about the depreciation you use for your PPE. Am I communicating? Maybe
Yes,
you were
sir.
changing, I discovered that you are changing depreciation method every year. Now, and I ask the as an auditor now, and I wants to you can change the your method of calculating depreciation if because accounting there's consistency. There's a accounting policy that it talks about consistency. It say that if you have adopted a particular method, that you should continue to use that method until situation warrant you to use the method. Am I communicating now? Now, I discover that you are just changing the method at which you are preparing your your PP schedule. That means calculating your depreciation and your accumulated impairment. I just discovered that is not well understood now. Now, look at it now. I will now write to you that you should provide which method are you using for your depreciation, and why are you changing your accounting method for calculating depreciation on a regular basis or yearly, and your impairment now, is your impairment in line with IS 36, and if it is in line with IS 36, what is your recoverable amount and what is your carrying amount and what is your impairment now? State it according. You give a format to how it should be the management should reply. What have you done now?
You are requiring him to write to.
That means you have actually provided the format at which he will respond back to you. Are you getting it now?
Yes, sir.
So that's why it is drafted by the auditor, because it's the auditor that require an explanation. Are you getting what I'm saying now? It requires an explanation, and that explanation, how that explanation should be provided, the auditor will provide it, so that the management will not be they will not be deviating from what is requesting. It's just like in my place of work now, there's a unit, there's a what's it called? If the auditor, look at it now, there was a particular time where they were auditing my organization. Now, in auditing my organization now the external auditor actually now request for a particular information. He now gave the format at which that information should be provided. What is he doing? What is that person doing now? He's providing the format at which that we will reply. So provide this in this format, provide this, I need this information, I need this information, and this information. So when we are responding, that means we will respond in accordance with that format that the auditor has given now. Am I communicating?
Yes, sir, I understand.
Yeah.
Thank you.
You're welcome. So we have stated that a letter of representation or written representation is usually drafted by the management, by the auditor rather, by the auditor. It is drafted by the auditor because it's the auditor that knows the area in which you need explanation. So it will draft it so that the because the auditor will inform the management in his letter or in his oral address now, maybe oral address. He will have provided out the format we look at. And that written representation is actually addressed to who? To the auditor. And date as early as practicable. That means the date. That means it should not take time in providing written representation. Management should not take enough time in providing the written representation. So you can see a format of written representation actually in page 200. Okay. Madam Omolara. No. It's not written by the auditor. The auditor is just giving a format at which you should the format at which that written representation should be provided. Do you get what I'm saying now? Ma, sorry ma, do you work in ministry, or I want to ask a question. Do you work in ministry?
No, not at all.
Now, there are some times where maybe let's imagine now that EFCC is actually auditing your company. Are you getting what I'm saying? It's auditing your company now. Let's say EFCC is auditing your company now. Sometimes when they require for information, they will give you the format at which that information should be provided. Are you getting what I'm saying, man?
Yes, sir.
So if they are providing how you should respond and the information that you should provide it, what have they done? Have they not drafted how that written representation should look at? Like,
Yes, sir.
they have drafted it how it should look like. So that the reason why they are in their own letter or in their own oral address to you about how the written representation will look like now. That means the reason why they are providing the draft or how the requirement of the written representation that so that you not deviate from it. You not say, you not explain to us now. Is what you ask us that you prepare. So they will state it clearly that this is what they need. This is what they need explanation on. Are you getting what I'm saying? That's why they say it is drafted by management. It is drafted by the auditor. That means the content at which or the requirement at which that written representation will look like, the auditor will have specified it to you. It's not left for the management to now to follow that specification. That's what I'm saying. Do you get it now, man? Hello, Mommy Omolara, do you get it now?
Yes, sir. Yes, sir. Thank you very much.
Now let's go to the next now. I just laughed now. Look at it. Refusal to provide requested written representation. What? Who can explain that statement? Who can explain that statement? Refusal to provide written representation. You are now telling them that they should provide written representation and they refuse to provide the representation. What will the auditor do? What is required by international standard on audit 580 that the auditor should do when management refuse to provide written representation? You can be given a case study scenario and they say as an auditor that what you should do because the management has not provided written representation. Am I communicating? So look at it now. This is what the auditor should do. Now the auditor is now required that he should discuss the matter with the management. He should go to the management and report and discuss the matter. Sir, I've actually informed you that you should provide a written representation or letter of representation in a particular aspect of the financial statement that is not clear to me, and I see that you have not provided it. So he should discuss the matter with the management. Am I communicating now? 2 is that the auditor must re-evaluate the integrity of the management. He should re-evaluate the integrity of the management and reconsider the impact on other representation and audit evidence. Look at it now. Refusal to provide requested written representation. That means, look at it oh, you have been asking for written representation on a particular area some specific area of the financial statement. The management has been providing it. Now, a particular area you now request that they should provide written representation. They now refuse to provide it. What has happened now? That means there's something fishy. So you should also check other written representation, reconsider other written representation that the management has been provided. Check whether they are truth or whether they can be used as audit evidence. Am I communicating now? Do we get it? Now the auditor will not take. what I say is that, look at it now. You have been asking for information from the management or asking for written representation from the management. They have been providing it. There's no specific area that you now need written representation. They are now refusing. They are now playing you here and there, here and there. What they are saying is that you should what? Reconsider the impact of that written representation on the other written representation that they have provided to you. Are you getting what I'm saying now? You know, they have provided written representation to you before, but this one they are not providing written representation to you now. You should now what? Look at the impact of the one they've refused to provide written representation to. Look at the impact to the other ones that they have provided written representations to, because the matter may be related to the one they have provided written representation to, and that one may not be truth. Are you getting what I'm saying now? Are you getting what I'm saying, ma'am? Hello? Are you getting what I'm saying? What I'm saying is that one that they have refused, the area in which they have refused to provide written representation may have an impact on the one they have provided written representation on. And you should consider that written representation. You know, written representation stands as evidence. You should also what? Reconsider it as audit evidence. Is it appropriate for me to consider this other written representation as evidence? If I want to use it as audit evidence, can I rely on it without the other one that they have refused to what? To provide written representation of? That's what we are saying. Because one written representation may actually lead to another. So you should look at the impact on other written representation. They said, lastly, take appropriate action. How do you take appropriate action? You consider the effect of that refusal to provide written representation on your audit report. Are you getting what I'm saying? You consider the effect on your audit report. Any question? Any question?
No, sir.
So let's go to using the work of an audit expert. What do you mean by audit expert? Now, let me just explain what audit expert is that. Okay, you can go on, man.
I know expert is someone that is knowledgeable that have competence in other things.
Yeah.
That have competence in things other than accounting skills.
Okay. That means the auditor may actually not have that skills or may not have the competence in that area. That we will now need someone. You will now need to get someone that will enable him to what? That will not carry out work on that aspect that he may not what? He may not have adequate knowledge on. Are you getting what I'm saying now? That's what we call audit expert now. Look at it. Auditor may use the work of an expert to provide knowledge relevant to the audit. Are you getting what? May use the knowledge of an expert to provide knowledge relevant to the audit. Look at it. Which the audit firm itself does not possess. So the audit firm may not actually have the expert traits to actually carry out work on that particular area. An example of that is legal opinion. Legal opinion. We are not lawyers, we are accountants, or you are auditor. You may not have the legal opinion, what the law is saying, the interpretation of the law concerning some, because audit is not about you following or preparing the financial statement in accordance with financial reporting, or financial international standard. It is when you say true and fair view, it means that have you followed the rules and regulation? It is not only accounting standard though. So it means that the auditor can actually rely on the work of an expert in an area that they don't have competence or they don't have the required knowledge to carry out the work now. Am I communicating? Now, for an auditor to use the work of an expert, he must assess that expert, the work of that expert. And how will he assess the work of the expert now? How will you assess the work of the expert? What did I say? I said for auditor to make use of the work of auditor expert now, he must assess the work of the expert. Am I communicating? I say he must assess the work of the expert. So how will he assess the work of the expert? Oh yeah, how will he assess the work of the expert? Hello? How will he assess the work of the expert?
By assessing the fee
Mm-hmm.
the expert charges.
Mm-hmm. The fee. Okay. So you are just saying that if you want to use an expert, that means the benefit must outweigh the what? The cost. Are you getting what I'm saying now? Are you getting what I'm saying now? So because if you want to use an expert, if the cost is more than the benefit, what do? You will not need to engage that expert. But however, this is the way in assessing the work of an expert. This is a procedure that you need to follow because you may be given a scenario and you may be asked that what scenario or what are the procedures that you use to what to assess the work of an expert. So let's look at what international standard on audit 620 says about assessing the work of an expert. So that means if international standard on audit 620 require the auditor to apply the procedure spelled out below when using the work of an expert. That means there's a procedure that you need to follow before you can what? Before you can adopt or before you can use the work of an expert for an audit. And this is the procedure. The auditor shall, one, you shall obtain an understanding of the expert field of the expert field of expertise. That means you must be able to identify what is the nature, what is the scope, what is the objective of the expert work. That's what they are saying. So you need to obtain the understanding of the expert work, looking at the nature of the expert's work, looking at the scope of the expert work, looking at the objective of the expert work. But by the time you look at that now, you will be able to understand the work of the expert. Because if you don't understand the work of the expert, you can't just rely or use the work of the expert for your audit. Because if you provide an inaccurate audit opinion, it is the responsibility of who? Who will bear the liability? Is the auditors that will bear the liability because you are the one that engage the experts to carry out that work for you. So he said, international standard on audit 620 state that before you use the work of an expert, you must be able to obtain an understanding of the nature, of the scope, and the objective of the expert's work. Now, two, procedure is that the auditor shall agree the terms of engagement with the experts. You shall what? You shall agree the terms of what? Of engagement with the partner. That means if an expert now wants to carry out a work for you, their experts should what? You should have an engagement. You should have a terms of engagement. That means there should be a letter of engagement that will state the scope, the nature and the objective of the expert work, that will state the responsibility of the expert and the auditor. It will also the forms of the expert report and the confidentiality requirement. This is going to be stated in the letter of engagement or terms of engagement. Am I communicating? Am I communicating?
Yes, sir.
Yeah. Now, when you have obtained the understanding of the scope, or when you have understand the nature, the scope, and the objective of the expert work, and you have obtained there's a terms of engagement between the expert and the management, between the expert and the auditor. Now, what will you do now? That means you now evaluate the adequacy of the expert's work. How do you evaluate the adequacy of the expert's work? That means, is the conclusion reached by the expert the conclusion reached by the expert, is it in line with the engagement letter? Is it in line with the engagement, the work that the auditor has, the expert has done? Is it in line with the engagement? The conclusion he has reached, is it consistent with other conclusion? Am I communicating? This is how relevant is the work of the or the data used by the expert? Is it complete? Is it relevant? Is it accurate? These are what you look at for you to evaluate the adequacy of the work done by the experts, by the auditor experts. Any question on that? Any question on that?
No, sir.
Now, I will see.
Like this forensic expert, I think it's part of what we're talking about.
Yeah, it's part of it, sir.
Forensic.
Yes. You are right, sir. It's part of it now. Am I communicating? It's part of it. It is when the auditor has looked at this now that the auditor will know whether the expert's work is adequate enough for him to consider it. That means, after looking at this procedure, if the work of that expert is not adequate enough, he should not include it in his audit report or consider it now. Now let's look at this one. We have talked about this before. The external auditor reliance on the work of the internal audit. Now I want to ask, when will the external auditor rely on the work of the internal audit? Because this one does not even because we have done internal audit. When? Okay, one after the other.
When the external auditor accepted and be sure that the internal control system is effective.
Is effective. Thank you. That means it will carry out what we call test of control. Are you getting what I'm saying now? Yes, it will carry out test of control. And when it's relying on the work of internal audit, what is it doing? That means, what audit approach is it using when it rely on the work of internal audit?
It's using system-based.
System-based, yeah. That's just it now. So that one, it will not require so much. It does not require so much explanation now. That means, for an external auditor to rely on the work of internal audit, it will need to be sure. Are you getting what I'm saying? It will need to be sure that the internal control, that means the internal auditor has a degree of what? Independence. Am I communicating? And in carrying out this, you will need to test the internal control in the organization to be sure that the internal control system that has been put in place by the management is actually appropriate or effective. Am I communicating? So now let's look at the factors. Let's look at the factors that the external auditor will consider. The factor that the external auditor will consider in assessing the internal audit. What are the factors that you will consider? What are the factors that you will consider? Because they can tell you that you should state out what are you going to consider before you can rely on the work of the internal audit now. So one of the factors now that the external auditor will consider before relying on the work of the internal audit is the status of the internal audit department within the organization. When we say the status of the internal audit within the organization, it means that did they have degree of independence? What is their level of objectivities? Are they being objective in their work? This is what the auditor will consider now. This is what the external auditor will consider, because if there is no degree of independence and there is no objectivity in that internal control, that means the external auditor cannot rely on this. But when this is in place, the auditor can consider it. Also, the external auditor will need to look at the technical competence and the professional care of the internal auditor. Is this someone that is sound? Is it someone that is competent, that has the technical skills to work as an auditor? If the auditor does not have the skills now, or does not belong to any professional bodies now, or any accounting bodies now, you should know that the auditor may not have the professional care or knowledge to for the internal audit. That means the internal auditor cannot rely on his work because it does not have the sufficient technical competence and professionalism in performing his work. Because someone that does not have competence, that does not have the technical competence in audit or in accounting profession, and is carrying out and is the internal auditor of an entity, will external auditor rely on his work? No, because he knows that that work will be full of errors. So another thing that the external auditor will consider before relying on the work of the internal auditor is the need for effective communication between the internal auditor and the external auditor. That means if there is no effective communication, that means whenever the external auditor actually needs some information or needs some explanation on some area, if there is no effective communication within them, what happen? It will affect the work of the external auditor, and this is what the external auditor will need to look at before relying on the work of the internal auditor. Because if there is a degree of independence and the objectivity of that internal control is there now, if the internal control officer or the internal auditor is having the technical competence or due care now, but if there is no effective communication between them, will it not affect the work of the external auditor? Will it not affect the work of the external auditor? It will affect the work of the external auditor. So in that aspect, what you cannot finish, the external auditor should not even start it. That means, but if there's effective communication between the internal auditor and the external auditor, that means if all these three things are in place, that means the auditor can now rely the external auditor can rely on the work of the internal auditor. Are we together? So let's go to the audit. Let's move to audit quickly. Let's just move to the audit, and I think that's the second to the last aspect. Let's move to the audit of accounting estimates. What do you mean by estimates? Someone can just give me an illustration or simple definition of what we understand by estimate. What do you understand by estimate? When you say the word estimate, accounting estimate, yeah, someone. I've been the one talking since. Yeah,
It's just like an approximate value.
approximate value. That means you are not sure, it's not accurate. You are just trying to approximate that this is what the value should be. Am I communicating? Especially when you are using the management are using what's it called? They are using judgment. Are you getting what I'm saying? They are using judgment. It's not based on what's it called? It's not actual. What do you say, sir?
I said it's based on judgment.
Yes, it's based on judgment.
I
So
said based on judgment.
yes, and when anything that is based on judgment is not what is subjective. It is not objective. Am I right? So it may be wrong. It is not accurate. So look at it now. You know, it is very important for the auditor to look at some accounting estimate that the management have used, because it's management that is preparing the financial statement. You will need to audit the accounting estimate to check whether that accounting estimate is reasonable. Because if it's not reasonable, you can have material misstatement in the financial statement. Let's look at it now. They are using an estimate, and the estimate they are using, the basis of which they are using the estimate, the basis of the appropriation or the amount they have gotten is actually very wrong. What will happen? It will affect the financial statement. So let's move to what we mean by estimates now. So estimate is let's see how international standard on audit 540 define an estimate. It defines an estimate as an approximation of monetary amount in the absence of perceived means of measurement. That means there's no means for you to measure what the amount of this item will be, or what the amount of this asset will be, or the amount of this liability that will incur. There is no measurement that you can use now. You are now using an appropriation, what you think can be the value now. That is what we mean by an estimate. An example of an accounting estimate, we have allowance for doubtful debt is an example of an accounting estimate. We have warranty obligation is an example of an accounting estimate. Asset useful life, because you don't know the useful life of the asset, you are just estimating that the useful life of the asset maybe 5 years, 10 years, is an accounting estimate. Now, litigation settlement or judgment, whether you will win a court case or not, is an accounting what? Is an accounting estimate. That means the cost that you will incur for a litigation settlement. You don't know the amount that maybe the judge will actually pronounce that you should pay as penalty, or how much they will award to you as compensation. You don't know it. It's also under accounting estimates now. Outcome of a long-term contract. Outcome of a long-term contract is an example of accounting estimates now. Now let's go to, we have talked about the meaning of accounting estimate now. Let's go to the auditing procedure. That means if an auditor wants to carry out the audit procedure for accounting estimates, what are the procedure that he must follow? What are the procedure that the auditor must follow? That's what we want to look at now. Now, the procedure that the auditor must follow is that the auditor must look at the requirement of the applicable financial reporting framework. That means the accounting framework that is relevant to that accounting estimate. What is the requirement? What is the disclosure? How should the accounting estimate be carried out according to the financial reporting framework, or to the appropriate accounting standard? The auditor will need to look at that now when actually performing auditing procedure for accounting estimates. Now, the auditor will also look at how the management identify the transaction or event. How the management identify the transaction or the event. He will look at it. He will look at what is the transaction and what is the event that the management use in determining the accounting estimate for that transaction. Now, he will look at it. Did they disclose the estimate that the event or the transaction that leads to that disclosure? Did they to that accounting estimate? Did they disclose it in the financial statement? He will look at what are the nature of the estimate that you use. Is it a case? Is it relating to assets, or is it relating to liability? So you need to look at the nature of the estimate. So the auditor will look at it. These are things that the auditor will look at. The auditor will also review the procedures that is used by the management for the estimate. To make the estimate, the auditor will review it. Is this procedure that the management has, is it consistent with how estimate should be made, the auditor will look at this now. So also the auditor will what? If possible, the auditor may check the amount of the estimate against other known facts. Whether that estimate they have using now, the estimate they are using, can we get the amount from another source without using an estimate? If possible, the auditor will check. Okay, he wants to determine that the price that the okay, let's say let's look at the issue of Dangote now. I think Dangote group of company, I think one of their truck driver actually caused an accident that caused the death of a particular individual. I can't remember the name of that sister girl. That Dangote now gave them 20 million, gave the family 20 million now. Now that 20 million that he gave the family now, let's say the family now say they are not the 20 million is not okay. They can't take the 20 million. The loss they have suffered is more than the 20 million that is given, that they want to take the case to the court now. Am I communicating now? Now, let's say there is a similar case. Now, that means Dangote is now saying that if they take they are now making provision. Like, if they take that case to court, if the family should take that case to court, there's a possibility that they will incur additional 100 million. Are you getting what I'm saying now? Now, what they are saying is that they have recognized an additional liability of 100 million. It is not the actual amount they will incur, but they are now estimating that this is the amount that they will incur as liability for that case. Now, let's say there is a similar case that has happened proud before. That the amount that was awarded to the family that lost their children or their child, let's say, is 300 million. What has Dangote companies done now? What has happened? They have underestimated the what? They have undercast or underreport the liability now. That's what the auditor will look at now. He will look at, if possible, the auditor will check the amount of the estimate against other known facts to check whether that estimate they have made, whether it's appropriate or not. So let's review again the auditing procedure for estimates, for accounting estimates. One is for the auditor to check the requirement of the applicable financial reporting framework. That is the standard that talks about that is relevant to that transaction or to that event. So the auditor will look at it. What is the standard saying about how to use accounting estimate and the disclosure that is required for that transaction or for that event now. Two procedure is that the auditor will identify how the management will look at how the management identify the transaction or the event that leads to the what? To the accounting estimate. That means the transaction or the event that the management is using accounting estimate for, how the management are able to identify it. How are they able to identify such an event or such a transaction that they are using accounting estimate for? Now, the auditor will also look at the nature of the estimate. Is it a liability? Is it an asset? What are we giving as what is the possibility that we have a liability? What is the possibility that it will be an asset? These are the nature of the estimate that the auditor will look at. Is it an asset or liability? Now, the auditor will also review the procedure that the management has used to make that estimate, whether it's correct or not. The auditor will look at it. Did they use an expert for it? Did they use an expert for it? Did they use an underlying assumption? These are what the auditor will look at. Now, if possible, the auditor can, lastly, if possible, the auditor can what? He can check the amount of the estimate against other known facts. If there's a way that he can consider, or there's other facts, just like the way I explained now, that means the similar case has happened before, and they have made an estimate of 100 million. But a similar case that has happened previously, the family that incurred the loss was awarded 300 million. That means the company will pay 300 million, and the company has only made an liability of 100, estimate of liability of 100 million, that if they lose the case, that's the amount they will incur. But the similar case has been awarded to before to the victim, that is amounting to 300 million. We can see that the company has undercast or undervalued the liability that they have made. That means the estimate is not correct, and this estimate can cause material misstatement in the financial statement. Any questions so far? Now let's look at auditing of fair value measurement. What standards talks about fair value?
That is IRS 13.
How do you define fair value?
Fair value, I think that should be the price
If-
paid for selling an asset or transferred or paid
to transfer a liability between what?
the market within the market participants
Mm-hmm.
in the transactionally it's an orderly manner like that.
Yeah, you are retry, sir. So that's fair value. That means, we have different is it measurements? I can't remember. Techniques. There's different techniques that can be used for what? For measuring fair value. Do you remember? I think we have
Level 1 to 3.
no, it's not level 1. That's hierarchy of fair value. We have I think measurement techniques. I think we have market approach.
Market approach.
We
cost
have
and income approach.
Yes, cost and income approach now. Now, it is the management that will actually use this approach to evaluate the fair value now. Now, look at it now. The auditor will also need to what? To measure the fair value measurement that was used by the management now. Are you getting it? He said, issue relating to the audit of fair value measurement are similar to those for the audit of accounting estimates. That means the audit of accounting estimate that we listed now, it is similar. Are you getting what I'm saying? So if you know the auditing procedure for accounting estimate that I've listed now, it is similar to that of auditing of fair value measurement now. Am I communicating? That means the auditor will need to look at the applicable financial reporting framework. Are you getting what I'm saying now? For measuring, accounting, and disclosing the item that was value for fair value. What are the procedure that the management use for measuring their fair value? These are what the auditor will look at now. Am I communicating? Now, the auditor will also need to consider some risks if he's carrying out the audit of fair value measurement. He will need to consider some risks. And what are the risks? He will need to consider control risks, inherent risks, and detection risks. What are the risks that is in inherent risks? That means if that fair value measurement is largely what? Subjective. If it's subjective, what do you mean by subjective? That means it is not based on data. It is not based on information. It's actually made based on what? Based on judgment. Are you getting what I'm saying now? So it's going to have inherent what? Inherent risks. Am I communicating?
Yes, sir.
Okay. Let's go to the control risk. What is control risk? That is related to auditing of fair value measurement. That means inability of the control of the internal control system to detect whether there is what, whether there's whether there's error, or whether there's error in the valuation technique that is used for the fair value measurement. These are what the risks that the auditor will consider. He will consider the inherent risk, because if the fair value measurement is used based on subjective, that means that amount or that fair value measurement now is going to be what? Is going to have inherent characteristics. But if there is risk that the control mechanism that the organization has put in place when using the fair value measurement cannot detect whether there's error in the valuation or in the measurement now, that means it will affect what? That is caused by a control risk. Detection risk that the auditor will consider is that if, look at it now, let me just read and conclude. Then the auditor may try to minimize the detection risk, but the auditor may lack the knowledge and expertise to verify fair value measurement. That means if the auditor cannot verify or cannot determine whether the fair value measurement that was used by the management or in the preparation of particular item in the financial statement is accurate or not, that means there will be what? Detection risk. Now, any question on that? See, the second aspect that we are looking at now is the audit of specific area of the account of the financial statement. I will not look at that at all, but you may be asked in the exam. Look at it now, so that you will see what you understand what I'm saying now. Look at it, page 295. I will read out before going to the transaction circle. Look at it now. I will read out so that you just see, so that you not say that there is standard. Why are they bringing standards for us in audit? Look at it. They say in your exam you may be required to apply general principle of obtaining audit evidence to a specific area of financial statement that are regulated by one or more of international accounting standard. Look at it. In order to deal with the exam question of this type, you will need to know the details of the relevant international financial reporting standard and or international accounting standard. Please go and know the details. Please, I'm begging you. Go and, because they can ask question on any of the standard. Okay, don't worry. Maybe when I bring a question out, you see the question on standard. You understand what I'm saying. So all those other aspects is actually talking about standard, borrowing costs. So please go and refresh your knowledge about standard. So I'm not looking at that at all. So let's go to transaction. Sir? This is the last aspect now. I will just conclude so that I will know I'm through with the topic. I think the topic is quite voluminous. I think after this topic now is the other topic that is voluminous like this is what's it called? Is chapter 14. Audit opinion.
What chapter?
This is chapter 8. So group audit is not as group audit cannot even take us 30 minutes for us to finish. So we'll look at that. So let's look at the other transaction circle. Transaction circle is the pattern at which transaction will follow. The procedure at which transaction will follow. Are you getting what I'm saying now? Before you can sell an item now, you must receive an order for the asset. When you receive an order for the asset, you deliver it to the customer. When you deliver it to the customer, that's when you recognize revenue, right? That's when you recognize revenue or sales. That's what we call transaction circle. So we have three main transaction circle. We have three major transaction circle. We have sales or revenue, we have purchases, and we have payroll cycle. We have what? We have revenue or sales. That revenue or sales can also lead to what? Receivable cycle. Because when you sell on credit, what happens? Your customer, you have trade receivables. So you have sales and trade receivable cycles. We have purchases and payables cycle, and we have payroll cycle. Actually, we have other transaction cycle too. We have bank and cash transaction and all those. But let me just explain something for you, because you may be asked in the exam that you should provide a checklist. You should provide a checklist for a particular transaction cycle. And when they say checklist, it means that the control objective, you should provide the control objective, the internal control, the test of control, and substantive testing. Let me explain what we mean. So you now look at one of, please, it is listed out here. So you look at it and understand what we mean by that. But I will explain what we mean by control objective. What do you mean by control objective? Control objective is what the organization wants to achieve. Are you guys understand now? Let's imagine now for our assets, for a particular asset now, the asset of the organization, what is the control objective that the organization wants to achieve? That means for an asset now, it means that the control, one of the major control objectives is that to prevent, are you gonna to prevent what theft or use by an unauthorized person. That's control objective. That is what we want to achieve for an asset now. I'm just giving an example now. That means the internal control now, that means those things that we will put in place to achieve our what control objective. That means before anybody move out of the store now, we will look for someone that there will be security that will search, that will look at them, search them, check their belongings, whether they did not move out with any of the any of the company's property. That is what we call internal control. That means those way that those things that will be put in place to ensure or to achieve the control objective. Now, what is test of control? Test of control is what the auditor what the procedure that the auditor will know whether the control or the internal control that the organization is put in place is it effective? Are they practicing it the way they have put it on paper? That is test of control. The test of control will be carried out by the auditor to ensure that the organization are following the control objective. Are they following it? Are they practicing it? Is it really existing? Are you getting what I'm saying now? Why substantive test is a way of of gathering evidence about the control, about the test of control. Please, you can look at any of the example. There's a checklist that has been provided. Like for revenue and expenditure now, there's a checklist for control objective, the key control, the test, and the substantive testing. Please try to look at it. You may not need to cram it. What you just need for you is just to understand how to set control objective, what is the internal control, what are the tests of control, and the how to carry out substantive testing. So maybe I can do a little voice recording on this aspect. On this transaction cycle, I can just do a voice record. Maybe I will just pick revenue and receivable as example and explain it. So thank you. Any question? Any question?